Welcome to the Sterling Trading Tech Roundtable video series. My name is Danny Corrigan, and I am the Director of European Business Development at Sterling Trading Tech. As a global provider of trading, risk, and compliance solutions, we thought it was important to lead conversations about the industry. One thing we've learned is how important the ability to have a custom house policy is for real-time risk and margin management. So we invited Ravi Jain, Sterling's Director of Risk and Derivatives, to the roundtable to gain insight on the importance of house policies globally and what is changing and evolving in this space. Ravi, thank you for joining the roundtable. So to get started, please introduce yourself.
Thanks, Danny. My name is Ravi Jain, as Danny mentioned. I am the architect for Sterling's risk and margin system, and I'm happy to be here today.
Thank you, Ravi. To start off, could you define the importance of a custom house policy and why you developed a custom house policy builder?
Sure. So around the world, margin requirements, and in particular in the US, margin requirements based on the regulations are typically based on a fixed percentage move across all equity symbols, or a fixed shock amount across all equity symbols. This may have been okay many years ago, 30, 40 years ago, when there was a lot less dispersion in the market. But today, given the amount of excessive idiosyncratic risk, in other words, some stocks symbols moving excessively compared to others, treating all equity symbols the same is just not a good measure of risk. And so firms have to employ their own internal models in which they shock different symbols, different amounts. They apply a variety of different measures like concentration measures, liquidity measures, etc. And to do that, they need to create their own house policy. We created a house policy builder that allows clients to create and manage their house policy themselves. They don't have to rely on bespoke coding. They can manage it using the building blocks that we've created.
Thank you, Ravi. So, Ravi, what do you think are the biggest overlaps and gaps when looking at the way risk and margin is managed in the US versus globally?
Sure. So the US has two very distinct regulatory environments, the futures and then the securities world or the equities world. And both have different ways of measuring, calculating margin requirements. In the equities and equity options world, the margin requirements are calculated either by Reg T or by portfolio margin. Both of them, as I mentioned earlier, the base regulatory requirement uses a fixed percentage move. So the maintenance requirement for Reg T was 25%, regardless of whether it's IBM or whether it's a meme stock. Similarly, the futures or the CFTC regulations they use the span methodology, but they don't. The span methodology doesn't change their margin requirements that often. Globally, however, we see that there's about 40 to 50 exchanges around the world that have adopted span, and they use span in different ways. Some of them, I would say, a little more intelligently than others, where the span shock requirements are based on the standard deviations of the individual symbols. And thus, the amount you're charging for margin is a function of the volatility of individual symbols. That's a much better implementation of margin calculations. However, there are certain regions, even in Europe, we see they've adopted something that's very similar to the US methodology, which is a fixed percentage across all symbols, which we think is a compromised way of calculating margin.
Thank you, Ravi. So we know there's a global inconsistency around regulation of margin and risk, but less of an inconsistency between the theory and application of risk management. So one last question, how do you see the US regulatory requirements for instance, portfolio margin and Reg T maintenance being utilized for other markets globally?
So the first part of your question was regarding inconsistencies in theory and application. You're absolutely right. Risk management has evolved dramatically over the last 40 or 50 years. And there are very strong methodologies in place within banks, within private firms, et cetera, on how to calculate risk. However, I don't see that the U.S. regulatory requirements forms a good base for margin calculations globally. I think there needs to be an overhaul on the U.S. regulatory margin calculations that needs to address calculation of risk, that needs to address the idiosyncratic risk nature. The regulators do it by requiring clearing firms to develop their own internal house policies. And I think this concept of a house policy is a global concept. And I think over time, we'll see more consistent messages from regulators on what to include in their house policy. And that's where we're also, that's been our philosophy, that by giving tools for creating bespoke house policies, you can address the inconsistencies or inefficiencies in these regulatory frameworks.
Ravi, thank you very much indeed. That was Ravi Jain, Sterling Trading Tech's Director of Risk and Derivatives.
Thank you, Danny.